Great. So welcome you once again to today's section. We will look at the IFRSs first, or the standards. So we will look at the financial reporting standards. Financial reporting standards. So that is what we are going to look at for today. Financial reporting standards. That is the agenda for the day. Financial reporting standards. Good. Great. Now let's continue the game. The standards are many. Which of them do we have to critically look? Then we will probably have to look at this standard, IAS's IAS 210, 12, 16, and then 40, and then 38. They are in the same category. Then we look at 36, 37. Then the IFRS is you have to look at basic 2, 15, and what 16. So these are the sections that we have to look out for. Okay, so basically, just that we will go through the questions and make sure that we solve questions under each of this. So that's so we start with our very first question, then we look at it. So the first question on the list will be the Samampa Limited. So let's look at Samampa Limited. That is what we are going to do now. If you have your material, you can open on the other device for us to go through it. Great. So this is the question. Now let's go straight to the requirements. Straight to the requirements. So the requirement is here. Required. As a financial controller who has just been engaged to help Samampa Limited to resolve the issues speedily, you are required to detail out the accounting treatment. So if you have the hard copy, you have to bring detail out the accounting treatment. But of the above transactions in accordance with the appropriate accounting standards. So detail the transactions, how they are going to treat them in the books. So we want accounting treatment. Accounting treatment simple means under each case, tell us how you treat each of the item. So that's the accounting treatment. Usually the solution move in line with the phrase that we use. Detail the accounting treatment or calculate the cost or post the relevant entry or prepare the relevant entry or extract. So each and every requirement and how we should solve it or answer it. Good. So that is it. So it means that this we have to go through each and every item and then explain to Samampa Limited on how they should account for it. So let's go to the At last, at the last annual general meeting of Samampa Limited, the shareholders were unhappy about the delay in submitting the audited accounts for them for study. Before the meeting, management of Samampa Limited attributed the delay in finalizing the account to the time spent by the external auditors in auditing the account. It has been discovered that the delay in presenting the account for audit is because the account officer was not sure of the treatment of the following transaction in the financial statement of Samampa for the year ended 30th June 2020. Good. So item number one. On July 1st, 2019, Samampa Limited acquired a machine under the following terms. So when we see something like this, here what comes to mind is the first, the treatment of these items. So that's the cost. How to obtain the cost of this item. So how to obtain the cost of what? The machine. So if it includes, we state it. If it excludes, then we state it. Then provide a little explanation. So we start with the very first item. So the solution will be A, the cost of the machine. So let's go to the board. A, the cost of what? Machine. So A, the cost of machine. The cost of machine. So I'll put here cost of what? Machine. Cost of machine. Cost of machine. Then I'll pick the item one after the other. If any of them will not hold, I just have to pass it on. So the two items they are looking for, items that should be part of the cost of the machine, and then the items that you have to ignore. All those items that you have to exclude from the cost of the machine, here proceed and tell us why you are going to treat it. Because here we did not ask you to just calculate for the cost of the machine. We went further and asked you a comprehensive question that detailed out how we should treat them. So if you're not touching it, tell us where it will go. That is the treatment. If they should have probably put a question in a form like this, calculate the cost of the machine from the above. Then now we need only the cost. Good. So you pick each of the item one after the other, then you sum them up. All those that will not be included, tell the examiner where you're going to treat them. Most of them are going to what? Operating costs or operating expenses. So we should take notes of that. Okay. So let's now I'm gonna sit here. So I'll pick the item one after the other. So the first item on the list. So if you have your material, you can open with me. So the first item on the list happened to be manufacturer's base price. Will it be part of the cost of the machine? Good. So with the manufacturer's base price, will it be part of the machine? Let's say. So manufacturer's base price will be part. Yes. So it's part of the purchase price. Good. So we will include it. Perfect. Then the next item on the list. So manufacturer's base price. All right here. Base price. And it's 1,050,000 cedis. Now what is the next item on the list? We have trade discounts apply on the base price only. So trade discount of what? 20%. So do we include it or we exclude trade discount? Good. Any idea for the trade discount? Now trade discount means a reduction in the price as a result of what? Bulk purchases. You are buying more of the machine, so they are reducing the price for you. Or you are buying, let's say, five, and they are giving you two extra. So now you have, this is the total cost of all the five, but all the seven machines. So here the trade discount must be subtracted. So trade discount will be subtracted. So you write here trade discount. They say 20% of the base price. So less what? Trade discount. Into brackets 20% times 10, 5,000. And that will give us 210. So if the trade discount is 210, what will be the value that we will get after the discount? So how much will be the payable amount? So the payable amount will be 840. This minus this. So that will give us 840,000. So then move on to the next item on the list. The next item on the list is early settlement discount taken on the payable amount of the base cost only. Early settlement discount, how do you treat it? Early settlement discount. Now, when you talk about early settlement discount, that's the cash discount. It's on prompt payment or prompt settlement. It's for those who pay their debt early on time. They will enjoy. Such an amount will not be treated here. It must be treated in the profit and loss statement. So early settlement discount should not be part of the cost of PPE. So early settlement discount should not be part of it. So we don't touch it at all. However, tell us where we are going to treat it. Well, it will be part of the other income of the entity, or we can net it off against the operating cost. You can write it off or as a gain in operating cost. So we subtract it from your operating cost. Good. So that is the treatment of that one. Please make sure that you touch on every item. The item that will form part of the cost of the PPE, we bring it in. Those that will not form part, we tell the examiner where we should treat it and give a reason. It shouldn't be plenty, just one line. You might treat it as what? Operating cost. Or you have to net it from the operating cost or the other income. Now the next item on the list, freight charges, 30,000. So freight charges is what? 30,000. Will it be part? Yes, because that's transportation by what? By air, right? Good. So transportation by air. So freight charges should be part of 30,000. Then the next one is import duties. Good. Import duties happen to be 20,326. So import duties should be back. So import duties. Good. Electrical installation costs will also be part. Good. And that one is 28,000. So electrical installation. Then staff training in use of machine. So they have to train the staff on how to use the machine. This should not be part of what the cost of the machine. Why? Because this will make the staff rather ready to use the machine. It will not make the machine ready for its intended use. So as a result of that, staff training cost should not be part of it. Good. So tell the examiner that the staff training cost, so you write point on it. So the staff training cost okay, before that, there's a question here. Now, the next on the list is the staff training cost. We said that the staff training cost should not be part. It must be treated as the operating cost. So let's write something small about it. Why? They said that the staff training cost will make the staff ready to use the machine, but not the machine, and hence it should be expense in the P&L. So the staff training cost must be expense, so in the P&L. Then the next item is pre-production testing. Will it be part? So pre-production testing will be part of the machine cost, so it's one part. So pre-production testing will be that of 22,000. So pre-production testing should be part. So let's go add it to it. So pre-production testing, 22,000. Okay, so the next item on the list will be legal and professional fee. So will legal and professional fee be part? Great. Legal and professional fee will be part. Yes, to be part. Because we said that the cost include any cost that is directly attributable. Now the professional fee, some of the assets before you acquire them, you need consultant to give you a professional advice before the acquisition of such assets. So that is the professional advice. It it include it include one, consultant use in acquisition, consultant use, and then legal, architect, surveyors, all of them. Okay, so the next item on the list is fact for legal and professional fee uh, is 30,000 on the list, which will be part. So let's write it. So legal and professional fee, that is 30,000, which will be part. So the next item is purchase of 3-year maintenance contracts. Purchase of 3-year maintenance contracts. Good. And that one also, will it be part? No, maintenance will not be part. So maintenance contract will not be part. However, it will form part of the operating cost. So it will not make the asset ready. The asset have to be ready first before they start incurring maintenance costs on it, before repairing it. If that asset does not exist, what are you going to maintain? What are you going to repair? So the asset must exist first before we think of maintenance. Good. So this cost will not make the asset ready. So therefore, it will not be part of what? The cost of the machine. However, it must be expensed in the P&L in the year that you incur them. So here said 3 years. So it must be divided by what? 3. And every year, 20,000 will be treated as what? Operating cost. Every year, 20,000 will be treated as operating cost. And that is. So every year, 20,000 will be expensed in the P&L goes. Because it's a 3-year, and then the amount is what? 60,000. So 60,000 spread over 3 years. Good. 60,000 spread over 3 years. Then you are probably done. Good. Okay, so that is it. The next item on the list will be estimated residual value. No, that is what we will use to calculate what? The depreciation. So after we get the cost of this machine and depreciation continue. Okay. Now, they are saying that the machine will cause an environmental pollution, which will be restored at the cost of 80,000 at the end of the useful life of the machine after 5 years. The cost of capital is what? 10%. The cost of capital is 10%. Good. So here, this is dismantle cost. Yes, it's in line with what? Dismantle cost. So it's the cost which you incur it in future. So cost that you are going to incur it in future, but must be part of the cost of the PPE. So dismantle cost is the cost that you incur at the end of the asset life. They are 3 in number. They have the same treatment, but they are a bit stubborn. Why are they stubborn? They are stubborn because you incur them at the end of the asset life, but it must be part of the cost of the asset, the initial cost of the asset. So how do you do that? So these 3 examples. 1, decontamination. So example 1, decontamination, like this question. 2, site restoration. And then 3, dismantle cost. All these costs have the same treatment. They are the costs that you will incur them in future after the asset life. But it must be part of what? The initial cost of the asset. Uh-huh. So what we have to do is this. We just have to find the present value and add it to the cost of the PPE and treat it as a what? As a liability, because we are going to pay at the end of the 5th year. So first, let's find the present value. So write here provision for decontamination. So decontamination cost. You find the present value. How do you find the present value of 80,000 payable in 5 years time? So it's 80,000 payable in 5 years time. Kindly divide it by that of the cost of capital. So 1 plus the cost of capital all to the power 5, because that's money you're going to pay. This is for the calculators that have the index power or that have the exponent function. If you are using the other type of calculators where you can't get the exponent or even fraction on it, then what do? Good. You can find a discount factor of 10% for 5 years and then you multiply. So you can find a discount factor. How do you find a discount factor? Step 1, just convert it to decimal. Add 1 to it, you get 1.1. So this is for the Macaulay type of calculator. Put here 1. It will be 1 divided by 1.1. Then you put the answer down, 0.909. Don't need to even write it. Then you punch it again. Then you hit on the equal to. So hit on the equal to 4 additional times. 1, 2, 3, 4. So if you're using the Macaulay type of the calculator, after this answer, just hit on the equal to. The next hit will give you here 2. Another one will give you here 3, here 4, and here 5. So after the 4th hit, so 1, the first answer comes, hit the equal to sign, and then like 1, 2, 3, 4 times. So it will give you, run it 3 decimal places, 0.621. So that's the discount factor for 10% year 5. 0.621. Then it means that the present value will be the 80,000 times 0.621. So this is what we will do to get the present value. Now, after getting the present value, we have 3 steps to deal with any cost that we get in future, the dismantle cost. Step 1, find the PV and add the PV of the dismantle cost to the cost of the asset. Let's put that way. So steps to deal with the dismantle cost. Step 1, add the PV to the cost of the PP. Add the PV, the present value, to that of the cost of PP. Step 2, the same PV, add the PV to your non-current liability. Treat it as what? Non-current liability. So the same figure that you get here, it will be a non-current liability. Why is it a non-current liability? We have not paid. We will pay it when? 5 years time. Because that's where we are going to incur such amount. So when you are done, then you relax. You come back to the one section. 3, you unwind the discount. Unwind the discount. I call it increase in provision. What can you do to the present value so that at the end of the 5th year, it will move or go up or increase up to the 80,000? Please, what's the present value, friends online? If you have calculated it, the present value. So you get 49674. That is the present value of 80,000 payable in what? In 5 years' time. Now, if I should draw the normal line very well for you to get it, it's like this. Now, the value today is 49674. What can you do to this value so that at the end of the day, it will move towards 80,000 so that we achieve our aim? The process of doing that is what we term as what? Unwind the discount. Where we discounted the cash flow to get the present value. So to go back, to remove the discount, you can't say on discount, it will not be nice. Then we call it unwind the discount because we have discounted it. So remove the discount back. If you remove the discount, it will move you to what? The future value. So remove it year by year. So how do you do this? You first of all multiply the present value that you have find, this 49674, by the cost of capital. Then you add it to the liability. So unwind of the discount first is equal to the present value that you have find times what? The cost of capital. In the PV at the start of each year times the cost of what? Capital. Times the cost of capital. So after multiplying by the cost of capital, whatever answer you get, treatment number one, it has two treatments, 1 and 2. So 1, you add it to finance cost because an interest cost. Add it to what? Finance cost. Add it to the finance cost. Treatment number 2. Treatment number 2. Add it to the liability at the start. Add it to the liability at start. So add it to fact. Add it to the non-current liability. That's all. So these are the 3-step approach for dismantle cost. So we are done. So over here, we sum all up to get the cost of the machine. Put all together, then get the cost of the machine. After getting this, tell them that depreciation will be based on what? This value. Depreciation must be based on what? This value. Or you can go further and calculate depreciation for them. Then you put it in. So that is how we get the cost of what? PPE. Good. Now the next one on the list, the next standard. So get the total for me. So to go over the decontamination, dismantle cost, site restoration cost have the same treatment. Or any other cost that you have to incur after the life of the assets. It should be part of the cost of the asset. For instance, if you obtain license to mine at, let's say, offshore sea point, the government will tell you that this license that you've acquired to mine in the country, make sure that at the end of the license period, you cover all pits or all holes that you've created. Good. But these holes, you have to what? Fill them after you upgrade them or after the life of what? The license. So it makes it a bit dicey. So you have to now find the present value of the cost that you incur to fill this hole. Then you add it to the cost of the license. Good. So the same thing applies to decontamination. First, you find the present value of it. So 80,000 payable in 5 years' time is the same as 49,674 in today's currency or in today's terms. That's what it means. So you key in this in the books, and the same figure becomes a non-current liability. So the same figure, so that to balance, other than that, it will not balance, debit and credit. So the same present value first is an asset. So add the cost of the asset, treat it as what? Non-current liability. Then when you are done, relax for a while. You have to perform a magic that at the end of the fifth year, this 49 will now be 80,000. And that's what we call unwind the discount. We discounted 80,000 and we had 49. So to remove the discount, so that to now increase again to 80 is what we term as what? Unwind the discount. If you think that term is too huge, just call it increase in provision. Because you have to increase the amount. So that at the end of every year, increase, so that at the end of the fifth year it will be what? 80,000. Because if you allow it to be constant at 49, and the fifth year you won't pay 49, you pay more than 49. So that's why we have to look at this. Okay. So good. So we have to, how to get the present value? Either you look for the discount factor and then multiply by what? The cash flow or the future value of the dismantle cost. Or you can go by this. I think the answer over there, the 49674 is when you use this one. 80,000 divided by what? Into bracket 1 plus 0.1 all to the power of 5. I think this particular answer that we have here is when you use this approach. Good. It's when you use this approach. So let's take note of that. Okay, so the next question. Good. Great. So now we can continue the game. The next standard on the list is impairment. Impairment. So impairment. The next one is about IAS 36, impairment of assets. So let's look at a brief section about impairment. It's one of the standards that examiner like. So I can say that 3 consecutive, I've seen impairment in this question. April 2019 in WCAD, October 2019 and last sitting. So we should look at impairment. So let's see a brief, something brief about impairment. Impairment. IAS 36 talks about impairment. Brief. Brief. So IAS 36 basically talks about how we test for impairment and then we account for impairment in our books. How to test and how to account for impairment. What is impairment? An interesting section. Impairment. So IAS 36, impairment of assets. Now, when you talk about impairment, it simply means the current amount of the asset exceeds the recoverable amount. So anytime the current amount of an asset exceeds the recoverable amount, that asset has been what? Impaired. So let's go practical. You have an asset here, and that asset the carrying value of that asset exceed the recoverable amount, then that asset has been what? Impaired. So that is the impairment. Good. So if I should go straight, we said the impairment exists if and only if the carrying amount of the asset is more. The carrying amount of the asset is what? Greater than the recoverable amount. So take notes of that. If the carrying amount of the asset is greater than the recoverable amount, then that asset has been what? Impaired. So if you have any asset there and you suggest that if you won't get the actual value, the value will drop in terms of, if you want to realize it, then that asset has been what? Impaired. Now we should know the difference between impairment and what? Depreciation. Impairment and depreciation. They are two different things altogether. Good. Now, even though they have the same treatment, but how they arrive different. Cost of them different. Now, with the depreciation, that one is a deliberate act. Impairment is not a deliberate act. No. Something must trigger. Something might cause it first before it will occur. But for depreciation, we don't need any trigger. Depreciation, that one a systematic allocation. We are spreading the cost. The asset will always depreciate. But impairment, something must lead to that. So anytime you are there and then you sense that you are losing something, you are losing something, quickly test for impairment. So that's why you are there and then you feel like checking up on someone. Then it come one, two. The third one, you pick your phone and call the person and see whether what you were thinking was true. If you call the person and then what you are thinking was not true, there's no impairment. Call the person, what you're thinking is true. Yes, there's impairment. If something bad was happening to the person, yes, that's impairment. You tested for impairment. Like if you send it to kitchen, maybe one day you left home, forgetting to hit your foodstuffs. So you're on program like this, then remember that you forgot to hit one of your nicest soup or stew that you've prepared. So it means that it is likely that the soup, by the time you go home, to spoil. So there's indication that the soup will be impaired. The value will drop, the taste will change. So that's what impairment. But it can also happen that maybe that soup can last for let's say 24 hours. That's do anything. So even if I've not heated it, it will still last for some time. Or someone in the house have done it for you already in your absence. Good. So that is the impairment. It's not something that it must be there specific. No, something must cause it. First, the soup, if you heat it consistently, it will not spoil. It will not do anything. Or put it in refrigerator, it will not do anything. Good. So it means that if you do it, impairment will not what? Arrive. But depreciation there, whether you put it in the refrigerator, if you like, just be watching it. Put it on the fire. Don't go anywhere. Still, it will depreciate. So for depreciation, then whether we like it or not, it will take place. But for impairment, something has to cause it first. Some bad item will lead towards impairment. Good. So that is. Now let's look at some few indications of impairment. So we have what we call indication of what? Impairment. Indication of impairment. Indication of impairment. I'm treating impairment because it's new to us. That's why we are just refreshing our minds. Summary of it. Indication number one, when there was a change, significant change in the use of the asset or change in technology. So change in the use of the asset, it might indicate that that asset has what? Been impaired. For instance, when you buy new assets or a new item, you always keep it well, or even to use it is something. But when the item become old, look at how you use it. You don't even care. So it means that anytime you change the use of it, there's an indication. Some organization, when they buy a new cars, it must be used by the head office. When the cars are getting older, they send to the branch, the local. Yes, but their road deserve what? Old cars. No, it means that that car has been impaired. There's an indication. There's something suggests that that car has been what? Impaired. Because you've changed the use. So you suspect that if you use it in the heart of its operations, you won't get the actual value. So that's why you've what? Change the use of the asset. Please, it does not mean that any vehicle, brand new vehicle you see in the bush or you see in the village, it has been impaired. No. If you don't have money to send brand new car to the bush, somebody have the money, it will do it. So, but that's it's an indication. It does not suggest that the asset has been impaired. No. Indication. So, to take note. Two, damage. Damage. When the asset is what? Damage. You are there and then one of the AC accidentally fell down. The AC fell down and then part was broken. True, you won't get the value from it. So there's an indication that the assets must have been impaired. Something like accident vehicles. That's sometimes most of the accident vehicles are a bit at low cost because it has been impaired. The value will almost drop. You won't get the current value. That does not mean that accident vehicles are not good. No. Or sometimes you can still test for impairment and they are still at their good position. So that is it. Then three. So the second one is what? Damage or accident. Then the third one will be changes in the interest rate. Changes in the interest rate. Then the fourth one is be the drop in the market value of the asset. If the market value or the fair value drops, there's an indication that you may not get the actual value of the asset. So that is it. Now, we basically have three steps of calculating for impairment. Impairment, not like when the asset fall down, you're going to calculate impairment. No, you have to test for impairment. When the asset is around, you have to test for impairment. After the testing, before, in fact, even in COVID, if you go to the hospital right now, they can't just look at your face and say you have COVID or you don't have COVID. No, you have to test for what? COVID and see whether you have it. The same will happen to impairment. Impairment, you have to test and see whether impairment exists or not. So we have the steps. First, there must be indication. Two, you calculate the carrying amount, and three, recoverable amount. And finally, you calculate the impairment loss. Then that is it. So these are the steps. So step one, there must be indication. So step one is what? Indication. Something must suggest that this asset might have impaired. So that is the steps in impairment. And the indication, we have the internal indication, external indication. We've looked at some of them. Yes. Look at some of them, but more to in the step two. Calculate the carrying amount of the asset. Step three, determine the recoverable amount. Recoverable amount of the asset. That's the step three. Recoverable amount. Then step four, you calculate the impairment, if any. So impairment exists if the carrying amount is more than the recoverable amount. So we have to look at this. So the step four is the impairment itself. is the impairment itself. It is the impairment itself. So impairment exists if any. It's not always. If what? Any. So after testing and then there's no impairment, we move on. Like COVID. The same thing. Now we should look at recoverable amount into detail. How do you get a recoverable amount? Recoverable amount, as the name suggests, is the amount that you can recover from the asset. One, through use or through sale. We said that recoverable amount is nothing by you compare two items and you select the higher. So the higher of two items. So number one, value in use. Value in use simply means present value of the future cash flows that you can generate from the assets, from the use of the assets. If you should use the asset, what will be the total value that you can generate from it? That is what we term as what? Value in use. So value in use is the present value of the future cash flow to be generated from where? The use of the asset. Then the next option is fair value less cost to sell. Fair value less cost to sell. So less cost to sell. So let me shortcut it here. Less cost to sell. So that is it. Fair value must be the market price or the selling price. Or you can also refer the fair value less cost to sell as what? The NRV. So compare two values and select what? The highest value. First, if you should use the asset, so you have a machine, you have, let's say, a machine that you use for a program or for business or the building. If you should use the building to the end of the building's life, what will be the value? So the recoverable amount of the building is nothing by this machine. If you use it to the end of the building life, what will be the cash flow that you can generate from this amount? In today's term, find the present value. That is it. That is the value in use. Please, it includes the scrap value most often. Don't bring it. The scrap value. It includes the scrap value. So it's also a cash flow. So if you use the machine at the end of the day, what will be the present value of the cash flows to be generated from the use of the machine? That is it. So that is the value in use. So the recoverable amount is nothing but you compare two values. If I should use this asset, what will be the value that I will generate? If I should sell this asset, what will be the value that I will generate? That is the recoverable amount. Okay. So let's see. Let's do it well here. Good. So we said that with a recoverable amount, is the higher of two items. One, value in use, and two, fair value less cost to sell. So in short, recoverable amount is the amount that you can recover from an asset through the use or through sale. If you should sell the asset today, after taking all the costs, all the selling costs from it, what will be the value. And please, here we said is the present value of the cash flows or cash flows to be generated from the assets. So you can make it present value of net cash flows. Cash flows. It includes a scrap value. Don't forget that it includes a scrap value of that asset. Then versus fair value less cost to what? To sell. Which is the same as what? The NRV. NRV. So fair value less cost to sell is the same as the NRV. So compared to, and start the highest one, because as a rational human being, you maximize the profit, the higher. Whatever you can recover must be high. Good. So that is the how we determine the recoverable amount.
Compare.
Yes, you compare and select the highest value. Okay. You compare and then select the highest value. So if I have an asset and then I did something like this, current amount of an asset is 200. Then the value in use is 150. Then the fair value less cost to sell happens to be 160. As the asset impaired, first, what's the recoverable amount? Second, what is the impairment charge, if any? So first, you compare the fair value less cost to sell, which is 160, to that of value in use to get the recoverable amount. So from this, we can determine that the recoverable amount is what? The higher, so 160. Current amount is what? 200. And the recoverable amount is what? 160. So therefore, the asset has been what? Impaired by 40 because we can't get the 200. Even we should get the 200 to break even. But if the value is 200, we should recover 200. Good. So basically, that is it. So over here, to cover the impairment, so it's a solution. So solution. Impairment will be current amount of 200 less recoverable amount of 160. So you get what? 40. Good. What if the value in use is 250? What will happen? I've changed it to.
The value in use is
Yes, it's 250. If the value in use now is 250, what will be the recoverable amount? We are done with the first question, so I've massaged it small. Now the value in use is what? 250. So therefore the recoverable amount is what? 250. Because it's what? More than 160. Good. So first we have to find the recoverable amount. We said recoverable amount is what? The higher of the value you use, which is 250, and the 160. Which one is higher? Then that's the 250. So therefore the recoverable amount is what? 250. So from the above, recoverable amount is what? 250. So let's go and calculate the impairment. The impairment will be, if any. So current amount of the asset is what? 200. Current amount of the asset is still 200 less the recoverable amount. What's the recoverable amount? 250. So that's 250. So here you get negative, eh? So impairment dash. We don't impair, how do you call it? We don't have a negative impairment or impairment gain. Either the asset has been impaired or it has not suffered impairment. Good. So that is it. So this asset has not been impaired because we don't have what you call impairment gain. For this asset, the recoverable amount is what? More than that of the carrying amount. So therefore, the asset has not been impaired. So this is how we test for impairments. If there's an indication, kindly test for impairment, and then it will reveal the final outcome. Okay, so basically, that is it. Now, sometimes the assets, this is impairment charge on a single asset. Single asset means that asset produce money alone. So if you have just a vehicle, one, that is on for rent, so that vehicle alone can produce what? The cash flows that you need. Good. But that's not the case always. Some of the assets they have to come together before they can produce money or cash flow. So if I've acquired a business, that business boundaries might have a building, other assets, all the assets have to come together before they can produce the money for you. So such assets, we call them cash generating units. So a group of assets that do not produce cash flows on their own unless they come together jointly before they can produce what? The cash flow. They are called what? Cash generating units. Cash what? Generating. They only generate cash when they come together. So for instance, if I have a conference room, then I rent it out. All the equipment that you see in the conference room, they come together to produce the money. So the building alone cannot produce the money. The stage alone cannot produce the money. The AC and then the other equipment that are fixed in there cannot produce the money. There must be AC, there must be a room, there must be a stage, there must be other devices before they can come and rent it at that amount. So if I want to impair, how do I impair such assets where they are in a group, they come in badges? So that is that section. Now, when it comes to single assets, it's a bit okay. Just that the value in use, we have to estimate it well. So we take note. So let's see cash generating units. So a group of assets that do not produce cash flow on their own except jointly. So if you take driver, throttle, the vehicle, and then the mate, these three people, only one cannot produce money unless the three come together. So that's a typical or a local example of what cash generating unit. How do you impair them? You first of all calculate the carrying amount of such an asset, then you share the impairment loss among them on 5 steps basis. So I'll use this question to illustrate the cash generating unit. So let's use this particular question to illustrate the cash generating unit. So let's go to this question. So Samantha B runs a unit of what? Sorry, Samantha runs a unit that suffers massive drop in income due to failure of its technology. So changes in technology can affect your business. Look at how now digital banking, online banking is moving. If you are a bank or a financial institution where you still use the traditional way of banking, paper, customer must be in there before transaction must be approved. So you will experience drop in what income. So the entire business will be impaired. Yes, we still have banks that, in fact, they should impair their entire some of their assets. Good. So let's see. On June 2020, the following carrying values were recorded in the books immediately prior to what the impairment. So before the impairment, before they tested for the impairment, these were the carrying amount of the asset. Number one, goodwill. Two, technology. Three, grants. Then land, building, and other assets. In fact, with the cash generating unit is a group. So if you see group of assets and they're talking about their current amount and testing for impairment, that is a cash generating unit. This unit, they can produce money on their own. So it's very difficult to have what you call to impair them individually, they cannot produce what? Value in use. What is the value in use? On their own, they can't produce value in use. The AC alone cannot produce the money that you want. The room alone cannot produce the money unless all of them come together as one. So it's very difficult for you to determine individually their value use. However, you can get a fair value. So unless you put them together, then we can generate what? The value use. So that is it. Okay. So such asset, they'll give us the recoverable amount as a whole. Or they can still give us the value use and what? That of the fair value less cost to sell. But it will be totality, not the individual. Everything they can do it when all of them come together, except the carrying amount. Okay. So let's see. The recoverable value of the unit is estimated to be what? 85. That's the recoverable what? Amount. So all what you have to do is you have to find the carrying amount and see whether that unit has been impaired. How do you know? Sum all the carrying amount together. It will give you the total carrying amount. You compare it with the 85 and see whether the carrying amount is more than what? The 85. If the carrying amount is more than the 85, that asset has been what? Impaired. That unit. Every asset. In fact, even if you test and then it has been impaired to affect everybody in the unit. Yes. Because if you use a rotten fish to prepare soup, all the other fish or all the other items in the soup also be what? Affected. So even if one of the assets within the unit has suffered massive drop, it will affect then everyone. So we have to now calculate the impairment and charge to them. Yes. Because like a body, they work together. Even if one is not there, the other one will not function well unless all of them are there. Good. Now the technology is what? Worthless following its complete failure. Other net assets include inventory. If you see any other net asset, it's a combination of three items. Inventory, receivable, and payable. They have subtracted the payable. Good. So that is it. So first step, there's an indication, right? So step one, indication. Yes, there's an indication. What suggests that impairment might have taken place? What suggests? In the question, if you read the top, they said that Samampa runs a unit that suffers massive drop in income due to what? Failure in what? Technology. So there's an indication. So that's an indication. So the examiner will cite something that suggests that they are going to lose something. Then based on it, you use it to test for the impairment. So step one, there must be indication. Yes, this one is an indication here. Step two, you have to tell me what? The carrying amount. Step three, recoverable amount. And then finally, we test and see whether there's impairment. So let's go. So first, let's go and calculate the carrying amount. So I'll go to the carrying amount of the asset. Here, all the assets they give you, can you sum them up to get the total carrying amount?
Step one is what?
Step one, there must be indications. Something must trigger that the asset has been impaired. They've done it already, so we won't start from there. We will start from the step two. The calculation start from the step two going. Then step two, calculate the carrying amount. So let's start. So here we are calculating for impairment. We are testing whether there's impairment, if any. So it can be possible that at the end of the day there's no impairment. It's not always, it's not deliberate, it's not specific. It's just something that must be there. Fixed. No. So first, carrying amount of the asset. So what's the carrying amount? Sum all the assets together to get the carrying amount. So let's sum all of them together in order to arrive at the carrying amount. Let's sum all the assets together. So all the assets. So the goodwill 20, technology 5, plus grants of 10, plus land of 50, plus building of 30, plus other asset of what? 40. That will give us 155. Perfect. So current amount is what? 155. So therefore, to test for impairment, you need to get the carrying amount of 155. Show again how you have at the 155,000. It's 155 million. Let me do this. Open a bracket here. Then you do all the workings in there. Then put the answer there. For purpose of what? Our text generation. We are going to generate text. Yes. At least for every question that you see, generate. If you see any question, then multiply the whatever is in it. If it's 5 marks, divide it by 0.25. It tells you that that's the number of ticks that you have to what, raise to us. At least number of ticks that you have to raise. Good. So let's continue again. Then step 2, we have to determine the recoverable amount. That's step 3, recoverable amount. Step 2 is the current amount. You've done that. So let's go and pick the recoverable amount. So recoverable amount, they have to give it to us. If they don't give it to you, just compare the value in use and fair value less cost to sell and pick what? The higher. How do you get it? Pick the higher. They don't tell you. So let's see. So in this, the recoverable value of the unit is estimated to be what? 85 million. 85 what? Million. So that's the recoverable amount. You've done it nicely for us. So I'll bring the 85 million here. I'll put it in brackets. So is there any impairment? If any. So you will not ask the question specific that capital impairment. No, no, no. We won't say that. You say capital impairment, if any. If you say capital impairment, that one we are sure. If the student calculate, they are not getting impairment, they say they are wrong. I don't want to do that. So we tell that if any. So if you go there and stamp, oh, they say any. So any can be either there's stamp or there's no. That like it be 50-50, you are not sure. So is there an impairment here? Yes, there's impairment. So long as the current amount is more than the recoverable amount, that's it as what impaired. That means currently the soup is tasting 155%. Even though eating it, it's not tasting what 85 or putting in a deep freezer. Forgot to do that. So it has been impaired by impairment loss of 70, right? So that's the impairment, 70 million. So the entire unit, even if it's a fault of one vehicle was involved in accident, and as a result of that, the value dropped. You have to test for everyone, but they are together. Good. Then after determining the impairment, then we proceed to allocate it or share. So we call it allocation of what? Impairment loss. Why? Because cash generating unit is not only one asset, they are group coming together. So do you look at their values or their face and give them this 70? No. You have to allocate it on specific order. You have to allocate it on specific order. Then you are done. Okay, so let's see. So we have steps that we will do. And then we have a table that we will prepare to do the allocation. So let me do it here. So allocation of the impairment loss. So now that we know that the entire group must be reduced or their value has gone down by 70, how did they calculate it in the book? So first, record the assets here, all the assets in question. List them again. Goodwill, technology, right? Brand, land, building, and other assets. Bring the carrying amount before impairment. Carrying amount before what? Impairment. And bring the carrying amount, bring the impairment itself here, and carrying amount after impairment. That is it. So this is how we are going to do it. Good. So let's look at this. Okay. So basically, that is it. Let's record the carrying amount. Goodwill 5 then. Goodwill is 10. Technology is 5. Or I've 10 them. After that.
No, Google is 20.
Goodwill is 20. Wow.
Yeah.
And technology is what? 5. Then brand is 10. Land
50, 50, 30, 40.
good. So this is the carrying amount before impairment. So first, we have to share the impairment based on this 5 steps. The first impairment must go to obviously impaired asset. Number 1, the first impairment charge must go to obviously impaired assets. So the first must go to obviously impaired assets. So obviously impaired assets. So which of these assets is worthless, valueless, obviously impaired? It has burned beyond recognition. One of the vehicles got burnt beyond recognition. This one is technology, right? Good. So the technology was what? Worthless. Let's go and read that note again. They said something that's very nice. They said the technology is what? Worthless. Following it what? Complete failure. So it is what? Worthless. So it must leave the system immediately. It is worthless. So it must leave. So technology. That's the first and number 5. So put it here and then put it in brackets. It suggests that we are impairing that figure. Then second, so yes, obviously impaired asset. Number 2, goodwill. Any goodwill must move. For example, goodwill rather even come first. In certain situation, goodwill, we got goodwill first. Top. Like goodwill should move first. Yes, goodwill. If you're in difficult times, your good public image cannot save you. Yes. So goodwill. So the next asset on the list, goodwill. So entire value must be reduced. So goodwill move from the system. Then the next is third one, move to intangible assets without an active market. Intangible what? Assets without an active market. Intangible asset without what? An active market. Any intangible asset. Example, brands, patents.
Not an active market.
Yes, without an active market. Active market. So intangible assets without active market. It means that in short, that intangible asset, if you don't have active market, that you don't have a fair value or selling price. If you don't have a selling price, you now you can't generate what value in use. You can't generate your own cash flow. And them today can't sell you. So what can you generate? Nothing. So in fact, your recoverable amount is what? 0. It's the same as you have obviously impaired. So it must be moved from the system. So that is it. So intangible asset without active market means they don't have a fair value, and therefore they cannot generate what? Recoverable amount. And that is, and it must move. Number 4, must go to any asset. Any what? Asset. Here is not intangible. Any asset that the NRV is lower than the carrying amount. So any asset where the NRV is what? Lower than the carrying amount. So any asset where the NRV is what? Lower than the carrying amount. Asset where the NRV. All this one will be part of the information given to you. Oh, this asset, the NRV is 30,000. No, and the current amount is 50. That means that asset has been impaired by 20. Maybe any of these assets, this one, they will tell you that this land, the current amount is 50. But the NRV, if you should sell the land right now, the way people have done guarantee on the land, if you should sell it right now, you get the actual value. You can get what? 30. Oh, then immediately, this land has been paid by what? 20. So let's impair it by 20. That's how the note will tell you. It's not in this note. So that's how like they will tell you. Good. Now the last one, step 5. If still there's some of the impairment, or we still have some of the impairment remains, we share it on pro rata basis. So step 5. The remaining impairment must be shared on the remaining asset on pro rata basis. On pro rata basis, based on your carrying amount. So you share the remaining assets on pro rata basis. Based on your carrying amount. So on pro rata basis, based
The
on your
remaining was carrying amount.
the remaining impairment. So far, total impairment is for 70. And now we have allocated 20 to goodwill, 5 to technology. So making 25 so far. So taking from 70, left with what? 45. So we still have 45 to be shared among the remaining assets. However, we don't impair other assets. So here put dash. That's the first thing we have to do. We don't impair what? Other assets. We say other assets made up of what? Inventory, receivable, and what? Payable.
That should be the first note.
And that is the first no, we don't impair other assets. And a good examiner should let you know. A very good examiner will let you know that. The other assets, the current amount of the other asset approximate their what? Their recoverable amount. It approximates their recoverable amount or be the reasonable representation of the recoverable amount. So that way they have not what impaired.
Other assets like
Inventory is made up of inventory, receivables, minus cash. So inventory plus receivable minus what? Payable, not cash. So inventory, cash should not be bad though. If they do have cash, we still have to add it because we are adding assets.
inventory and receivable.
Inventory, receivable, and payable. That's the most composition. So if you see inventory, receivable, and payable in some of the books or some of the questions, we don't impair receivable, we don't impair inventory, we don't impair what? Payable. We leave them like that. So let's prorate it. So far, how many assets left? 11 what? Brand, land, and what? Building. 11 3 assets versus an amount of what? 45. 11 what? 3 assets. So let's list them down here. I'll do some small workings here. Let me do it here. So let me brand. Brand, the current amount is what? 10 million. Land, the current amount is what? 50 million. Then building, the current amount is what? 30. So if I should put all the assets remain, I'll get 90, right? So I have to prorate it. Now the impairment level is what? 45. 545. Total impairment is what? 70. Now we've shared what? 20 and 5 already. So level 25. Like we've shared 25 already. So level what? 45. So that's the remaining impairment, 45. Which must be shared by the remaining asset based on your current amount, pro rata basis. So prorate it. So brand will take 10 out of 90 times what? 45. Land will take what? out of what? 90 times what? 45. Now what again? 30 out of 90 times what? 45. Whatever answer you get, that's what you have to key it in. So let's put it in. So what do you get for that of brand? That'll be 10 out of 90. That'll give us 9. 9 45 divided by 9, that'll give us 5. So brand 2 will be 5. If brand is 5, then this one must also be what? 25. If this one is 25, then this one must also be 15. It's coincidence that we are taking half. Coincidence. So now let's find the carrying amount after impairment for each of the assets. So that means,
So are we supposed to show what?
yes, you have to tell us how you arrive at these figures. You have to tell us how you arrive at the figures. Good. So what will be the carrying amount after impairment? So carrying amount after impairment will be first goodwill. So carrying amount before 20 minus impairment 20. So here will be what? Dash. It's gone. Dash. 10 minus 5, 5. 50 minus 25, 25. This here is coincidence that yeah, like half. Here is 15. Here is still 40. So you total them. So let's total all of them. The total carrying amount must be the same as what? 155 that we calculated there. Then the total impairment must be 70. Then the total carrying amount after impairment must be what? 85, which is the same as what? The recoverable amount. So that's the end of the impairment. So now you explain, tell the examiner that the accounting treatment will be like this. This entire 70 is an impairment loss. And we treat it the same as how we treat what? Depreciation. Wherever depreciation go, the senior brother must go there. Good. So depreciation and impairment, they are the same. They have the same treatment, but they are not the same in terms of calculation, in terms of meaning, in terms of how they occur, they are not the same. But in terms of treatment, they have the same treatment. So first, add it to the operating cost.
You put on employment.
Yes, this impairment. Add it to the operating cost. So the entire impairment of what? 70 million will be added to the operating cost for that particular year. Good. So that's the first treatment. Second, we have shared it here. So the asset must be stated at their what? Their carrying values after the impairment charge. So for instance, land, brand will be 5, land will be 25, building will be what? 15, and building 15, other asset 40.
So it will be assigned to it.
Yes, it will be added to the operating cost. Good. So basically,
And the second one.
the second treatment is that it will be shared and subtracted from the carrying amount of the asset. And that's what we've done here. So we take this one to the balance sheet. All these figures go to the balance sheet. So now the asset, the value of the asset is now made up of this.
To be shared.
So the 70 will be shared or allocated among the assets given below, and that's what we've done. Okay, so we are done with what? Impairment. Now let's move on to the next asset on the list. We are done with impairment charge. The next asset on the list is C. That is the investment property. That is investment property. That is the next asset on the list. Investment property. Okay. Now for investment property, a brief or a gentle reminder about them. So in summary, they are property that's made up of what? Land or building, IS 40. Property that's made up of what? Land or building or parts or both. So first of all, machines cannot be held as what? Investment properties. It's only landed properties. So land or building or part of a land or part of a building or both land and the building. Good. So that's the first feature. Feature number 2, acquired by the entity. Acquired by the entity with an intention not for use or for sale in an ordinary course of business. So take a look. So IAS 40 is not for use. Investment property. 3 features. Number 1, it must be land or building or parts or both. First, so property made up of land, building, or part or both. 2, acquired with an intention not for use or sale in an ordinary course of business. Not for use in production or sale in an ordinary course of what? Business. Not for use or for sale in an ordinary course of business. But for what? But for long-term capital appreciation or rental income or both. Yes. So this is the full definition of investment property. If you put these 3 terms together, it's a property made up of land or building or part or both, acquired by an entity with an intention not for use in production of goods and services or for sale in an ordinary course of business, but for long-term capital appreciation or rental income or both. So this will be the main reason. Okay, so that is it. Now you go straight. Recognition. It was recorded as what? Non-current assets. Measurement is the same as the one in IAS 16. Just that there are some little differences. So just look at the differences between how you record the investment property and owner-occupied property. Owner-occupied. The measurement, initial measurement is basically the same as the one we did under the IS 16 PP. So initially it must be measured at what? At cost. Subsequently, there are two measures, and that's where we have to critically look at it. Recognition, it must be recorded or recognized as a non-current asset if the two conditions are in position. The recognition criteria. One, it must be probable that future economic benefit will flow to the entity from the investment property. Two, the cost of the property can be measured without those 2 points might be with us. Okay. Now, let's see. Let's look at a subsequent measurement critically. Now, under the IAS 16, so I write IAS 16 here versus IAS 16 versus IAS what? 40. This is called investment property item. This is PPE. What are the subsequent measurements? Under the IAS 16, there are two models. What are they? So model one, we call it cost model. Cost what? Model. Two, we have revaluation model. Revaluation model. So these are the two subsequent measures of IAS 16. What about IAS 40? The same thing, but with slight difference. IAS 40, we also have what we call cost model and the IAS 40. So these two cost models, there's no difference, they are the same. So I can equate them. So I've joined them. So the cost model and the IAS 16 the same as the cost model and IAS 40. So in short, if we depreciate IAS 16 PPs and the cost model, we can also depreciate investment property and the cost model. So they are the same. Whatever we treat this, they are the same. However, the second one, we call it fair value model. Fair value model. But this one is not the same. But this is not the same as what revaluation model. So there are differences between the fair value model and the IAS 16 and the revaluation model. So we should look at the difference, critical, the difference between the fair value model. We should look at the difference between the fair value model and what? The revaluation model. What's the difference? They are not the same, even though the word revalued amount is the same as fair value, but they are different in terms of fair value model and revaluation model. Good. Now let's look at the difference into detail. The difference into detail. Okay, so I think you are getting a few points down. So let's look at the difference between the revaluation model and the IAS 16. In fact, IAS 16 can also call it owner occupied property. Owner occupied property. The owner has occupied him, so there's no room available for tenant. So owner occupied. So difference. Let me start with IAS 16 PP. By IAS 16 we call it what? Revaluation model. The revaluation model versus IAS 40 fair value model. Please don't tell us that one is under IAS 16, one is under IAS 40. And two, don't come and tell us that one is revaluation model, one is fair value model. Before you inform me. Before you inform me, look for a different and come and tell us. If not, I just recopy the question for us. Even though we want to hand for marks. Now, first, I look at this, the features. Feature number one is about depreciation. So depreciation. Yes, for IS 16 revaluation model, we depreciate the assets. So depreciation is conducted. So we depreciate what? The asset being depreciated. Or we charge depreciation. And IS 16 revaluation model, the asset is what? Depreciated. Yes, we charge depreciation. What about under the IAS 40 fair value model? No depreciation. Wow. No what? Depreciation. I like that. So we don't depreciate investment property held under what? Fair value. That's the first feature or first distinguished feature. We don't depreciate investment property held under what? Fair value. Held under fair value. Don't depreciate it. Feature number two. Carrying amount. CA. Carrying amount. Great. So the current amount, how do you obtain current amount? Yeah, the current amount of the asset and IS 16 revaluation model be calculated as follows. Is the revalued amount less what? The subsequent accumulated depreciation. That is the subsequent accumulated what? Impairment. Now I can mention impairment with COVID impairment. What about subsequent accumulated depreciation less, let me continue the formula, less subsequent accumulated what? Impairment loss. What about fair value model? Now, because we don't depreciate it, we pick the fair value at the end of the reporting period. So it's equal to what? Fair value at the end of the reporting period. So that is revalued amount less subsequent accumulated depreciation less subsequent accumulated impairment loss. Okay, so let's go to point number 3. Yes, fair value at the end of the reporting period, at the end of the year. Fair value at the end of the reporting period, or at the end of the year. above. Great. Point number 3. How do you record changes in fair value? So number 3, changes in fair value. Point number 3, changes in fair value. Point number 3. Changes in fair value. How do you record changes in fair value? At point number 3. That's fair value gain or loss, or the revaluation gain or loss. That is it. So first, all you have to do is under IAS 16, revaluation gain is reported in where it goes OCI. What about revaluation loss? Operating expenses in the P&L, or in short P&L. Good. So that is the gain. So changes in the fair value move to OCI under the IAS 16. And then changes, if it's revaluation gain, that is the OCI. If it's revaluation loss, goes to P&L. Please, and please again, let's take this one a bit careful. In the comprehensive income, if you take the comprehensive income, the profit and loss, from sales revenue up to profit after tax and to tax is to, that's the P&L. That's the only section that refers to as what P&L. The OCI is on its own, OCI. So this section is the profit and loss we're talking about, this OCI. Even though all of them fall in the same heading, that's comprehensive income, they are two different things altogether. For instance, if you check PCFM, OKFM, and NITFM, they're operating in the same building, but all of them are different. Good. So that also. So it means that these two are two different things altogether, even though all of them fall within the same heading. Let's go to IS 40. With IS 40, fair value changes must be reported to what? P&L. So all fair value changes. So changes means fair value gain or loss must be reported in what? The P&L. All fair value changes must go to where? P&L. That is it. So if it's a gain, other income. If it's a loss, operating cost. And then you are done. So now let's look at the last point, and then we close the chapter of the difference and go ahead and solve this question. Number 4. Point number 4. Point number 4. The difference between revaluation model and then the fair value model. So now the IAS 16 can be applied to all PP. Can be applied to all PP. So all PP. So it can be applied to all PP. We're talking about type of asset that can be used, the type of asset. the type of asset. Does it apply to all assets? Yes, IS 16 apply to all assets. Whether plant, whether building, whether land, whether machine, you can give evaluation. Very good. But IS 40 is so sweet when it comes to what? Land and building. For IS 40, it applies to only land and what? Building. Items made up of land. No. Land, property made up of land or building. Land or building or part or both. Okay, so that's the end. These are the differences. So let's need to back or solve this question. Great. So basically, if we take three types of assets, so every company sometimes, most of it, ideally have three types of assets. Asset that you are going to use for yourself, asset you are going to sell, asset that you are going to use it to rent. Good. So there are three types of assets. Each of them have its own standard. Asset you are going to sell, that's your inventory, IST. Asset you are going to use, PPE. And then asset you are going to rent, if it's land or building, investment property, how we get it. Good. So basically, that is it. Like forms of asset that we have in our books. Great. So let's see this. C, Samampa Limited acquired a building on 1st January 2016 at a cost of what? 35 million for rental purposes, which was set at what? 5 million. Which was set at what? 5 million. Good. The building have an estimated useful life of 10 years with a residual value of what? 5 million. Good. With a residual value of 5 million. The fair value of the building at the end of the first 3 years are as follows. So the of them are there. The following measurement basis can be used. So if you want to use the cost model, how are you going to state the assets in the books? Cost model and fair value model. How do you state the asset? Good. Great. So it means that having the investor property and a cost model, we are going to depreciate the investment property. How do you calculate depreciation? It is the cost of the asset. If the selling scrap value is less, and you divide it by what? The estimated useful life or the rates. So first, under the cost model, that examiner that the asset will be depreciated. So the building will be depreciated given by cost of what? So 35 million less 5 million all about 10 years. So that will give us 3 million per year. So that's the depreciation per year, 3 million. Okay, so that's the first thing. In terms of depreciation, it must be added to what? To two treatments. So treatment number one, each year depreciation must be added to what? The operating cost. So add it to operating cost or your admin. So depreciation 3 million per year. Every year 3 million. And which must be added to your operating cost. Two, we have to subtract it from the asset value yearly. If I should provide the extra, yes, this is the accounting treatment, only two treatments. Add it to operating cost each year, subtract it from the asset value each year, and then you are done. So if you should back it with what illustration, operating cost is the P&L. Let me do the financial position. So 2016, the current year, 2017, and 2018. The cost of the building will be 35 million, 35, and 35. Accumulated depreciation, first year 3 million, second year 6, third year 9. Carrying amount of the building 32 million, 29 million, and 26 million. That's how that's from the asset section. So that's what problem for okay. Okay, so that is the cost model. We are now in the cost model. We depreciate the asset. Let's go to the fair value model where we say we don't depreciate the asset. So let's see. Great. Now let's go to the fair value model. So under the fair value model, first, no depreciation. So no depreciation. First, the rental income of 5 million must be recorded in the other income. That one is a fixed position. The rental income of 5 million must be recorded in where? The profit and loss account. Income of the 5 million, we added the rental income of 5 million will be added to the other income. So it must be added to the other income. That is it. Okay. Then fair value model. Let's look at fair value model. Good. Fair value model. So the fair value model, one, the asset will not be depreciated. That's the first point you have to write. The asset will not be depreciated. First point. So fair value model, we don't depreciate the asset. First point. Every year the asset must be fair value, and then the fair value gains must be recorded. So tell examiner that under this model, the building will not be depreciated. Instead, it will be fair value at the end of each year. So here, the building will not be depreciated. The building will not be depreciated, but instead it will be tested for, or it will be fair value at the end of each year. It will be fair value at the end of each year. It will be fair value at the end of each year. It will be fair value at the end of what? Each year. So 2, given as follows. So it will be fair value at the end of each year. Then come again 2. Any gain or loss on valuation, on fair valuation, will be reported in a profit or loss. Any gain or loss on fair valuation, any gain or loss on fair valuation will be reported in the P&L. Full stop. Given by, so let's, and number 3.3, the building will be stated. The building will be stated at the fair value at the end of each reporting period. Now let's back with what? With calculation. So that means if I put P&L here, so I put P&L here, let me put 2016 here. Let me do it somewhere here. 2016, 2017, and 2018. When I do this, then I'll ask myself, what is the fair value gain or loss? If it is a gain, it goes to other income. Loss goes to operating income. You can also start with other income and put in bracket there. So now let's see. If I put Ghana cedi here, so first, let's see, at the end of 2016, what's the fair value?